Today we are going to cover the weighted average cost of capital. We'll be using the December 2017 sample question from ACCA. May you go ahead and download this question paper, as it will come handy when we are doing question 31. I assume that you have gone ahead and downloaded this question paper, and also now you are looking at question number 31. And on question number 31, we'll only do part A, calculate the after-tax weighted average cost of capital of Tufa Co. on a market value basis, 11 marks together today. So go ahead and download this question, then you come back to this video, as I will be referring to the question time and again. Now, before we cover this, calculate this weighted average cost of capital, there are few formulas that you need to master. So I'll show you the formulas. Then also, if you have not subscribed to my channel, please consider pausing the video and subscribing to my channel. Now, here are the formulas. There is dividend growth model, where we'll be calculating the growth rate in dividend, and this formula is not given in your formula sheet, so please copy it down and memorize it, and also know all the parts of this formula, where G is the growth rate, N is the number of years, D is the current dividend, and Dn is the dividend N years ago. The second formula is given in the formula sheet, so make sure you know it. RE is for cost of equity, G is the growth rate, D0 current dividend, PN X dividend, X div market value of a share, that is P0. Then we have got also the formula for the cost of preference shares, which is the current dividend over the market price of a share. We'll also do the cost of loan notes, where we'll use the IRR formula. The cost of bank loan, we'll use the same cost as the loan notes. We'll also use the IRR formula. Make sure you know this formula. Now let's go back to the question and answer it together, as I assume that you read the question and now you are ready to answer the question. Now, we are not given here sufficient information to use the capital asset pricing model, so we'll be using the dividend valuation model in this question. So for us to get the dividend valuation model, we have to calculate the growth first. So the growth is G. Then we have to find the number of years, we have to find the current dividend, we have to find the dividend N years ago, in order to come to this formula down here to calculate the cost of equity. So now we are going to go and find N, D0, and Dn to input in this formula. So let's go back to our question. Then first we say to calculate the cost of equity. Then our job now is to find Dn, D0, and N. We are given the X dividend market price of $7.07 and CAM dividend market price of $7.52. The difference between X and CAM is the current dividend. So the current dividend, we agree that is D0. So the D0 will say CAM dividend minus X dividend. We get the CAM dividend, the current dividend of 0.45 cents. Then now the dividend N years ago we are given here is 20x3. So Dn will be equal to 0.37. Then now we have to find N. Our N now, we have to count the years from 20x3 to 20x7. So when counting the years here, the 20x3 will be year 0, 20x4 year 1, 20x5 year 2, 20x6 year 3, 20x7 year 4. So we have got 4 years. So now we apply this one to our formula. Let me open the formula so that we apply it. We have got our G here, which is equal to, we'll be using this second formula here, dn over d0 over dn to the power 1 minus n minus 1. So we'll say equal bracket d0 divided by dn to the power, we open the bracket, 1 divided by n, which is 4, all minus 1. So we get that percentage. If we can reduce that to less decimals, we get that percentage, 5.02%. This is our growth. Now we have to calculate the cost of equity. The cost of equity, we have G now, we have got D0, we also have got P0. Let me show you the P0. The P0 is the ex-div market price. So we can put here P0 is equal to 7.07. Always use the ex-div market price. Now let's calculate our cost of equity, which is RE. We'll use this formula. I'll show you the formula here so that we'll be able to go together. The formula starts with dn. So we'll use this formula. So we'll say here, open bracket, we'll say equals, open bracket, we take d0, we multiply by 1 plus g. G is our growth here. We close the bracket. We close the bracket again. We divide by PO, which is 7. Then we add again the growth of G. We get that percent. Then now, if we can reduce the decimal places there, right, that is our cost of equity done, which is 11.70. Then now we move on with our question. We calculate now the cost of preference shares. Let me refresh you on the formula. The cost of preference shares, RP, is D0 over P0. This D0 is the current dividend of a preference share and the current market price of a preference share. So let's go to our question where we are given that information. We are given the 5% preference shares of Tufa have a nominal value of 50 cents per share and ex-dividend market price of 31 cents. So now, let me write here cost of preference shares. We said we want D0 and P0. So our D0 here will be equal to the dividend, as this is 5% preference shares. So the dividend will be 5% of the nominal value. So we'll say equals 5% multiplied by the nominal value of a preference share here is 0.50, which is 50 cents. So that is the dividend there. Then our P0 is the current market price of a preference share. We are given as 0.31. Now we can find RP P, which is the cost of a preference share, we said is D0 divided by P0. So that one, that is the percentage there that we get for the preference share. Now let's go and calculate the cost of the bank loan, the loan notes, cost of loan notes. This one we said we will use the IRR, and the IRR formula is this one. So let's go back to our question. To use the IRR, we have to find two NPVs. The NPV at the lower rate and the NPV at the higher rate. So we have to use our own two discount rates. I assume everyone knows to discount, so we use our two discount rates. So this table is very, very important that I'm putting here. Cash flow. We've got discount factors. I have chosen discount factors of 5%. I'll get the present value at 5%, and also discount at 6% and get the present value at 6%. You can choose any two discount factors and your answer will be marked correctly. Now let's go away and find the information about the loan notes. We are given here. The 7% loan notes have a nominal value of $100 per loan note and a market price of 102.34 per loan note. Annual interest has just been paid, and the loan notes are redeemable in 4 years' time at a 5% premium to nominal value. Here we'll also use this information here. The corporation tax rate is 30%. So we'll have year 1. This is redeemable in 4 years' time. So we'll also have years 1 to 4. We'll also have year 4. So in year 1, we'll have here our market value. In years 1 to 4, we will be receiving interest, and in year 4, we will receive the redemption value. Now our cash flows. In year 1, it's 102.34. That is the market value of that loan note. I will copy the formatting here and also copy the same formatting here and also copy the same formatting here. Now when we are receiving interest, we will receive interest net of corporation tax. So the corporation tax is 30, then the interest is 7% of the nominal. So we'll simply say 7% multiplied by the nominal, which is 100, multiplied by 1 minus tax rate. 1 minus the tax rate is 30%. We close the bracket there. So we'll be receiving interest net of tax of $4.90. Then we are told that the loan will be redeemed in year 4 at 5% premium. So we'll say 100 multiplied by 1.04, as it will be received at a premium of 5%. Sorry, so it's 1.05, like that. Now we have to find the discount factors. at 5%. In year, this is year 0, sorry. In year 0, the discount factor is always 1. Then in years 1 to 4, we'll get interest. So we have to discount interest for year 1, interest for year 2, interest for year 3, interest for year 4. Here I will only demonstrate it once, but you can use the present values or the annuity tables, but mostly the annuity tables are commonly used. So I'll only demonstrate why the annuity tables are used instead of the present value tables. Here we are saying we are going to receive interest for year 1 up to year 4. So we receive 4 times interest. Interest in year 1, interest in year 2, interest in year 3, interest in year 4. All those interests should be discounted to year 0. So we'll come to the column for interest here. For year 1, the discount rate is 9.52. We add the discount rate for year 2, 0.907. We add the discount rate for year 3, which is 0.864. We add the discount rate for year 4, which is 0.823. When we add them together, we get that figure. So this figure is it's an annuity factor, 5%, 4 years. Let's go to the annuity tables. These are annuity tables, 5%, 4 years. We get the same figure. That's why we are using the annuity tables here to discount. But for year 4, we cannot use the annuity tables because it's just one cash flow. We'll use the discount rate for year 4 at 5%, which is 0.823. We find again the discount factors for interest. As I have demonstrated, we'll use the annuity table here. 6%, 4 years is 3.465. I could have demonstrated again using the present value table, but we do not have time. Then discount rate for year 6 here is 0.792. We have our discount factors now. We will say cash flow multiplied by the discount factor. If we get this figure, we can drag it down. Then from here, we can have our sum here, where we'll sum all these. We get that figure. We can copy it and put it here. Then here, 6%, we will say the cash flow multiplied by the discount factor. We get that. We copy up to year 4 there. Then we get these are our net present values. Net present values here, NPVs. So NPV at 5%, 1.46 positive. NPV at 6%, 2.20 negative, like that. Now we want to calculate now the cost of loan note using the IRR formula. I will flag the formula here so that we will be able to follow through, as we have got everything that we need. The lower rate is 5%, the higher rate is 6%. We have got two MPVs, MPV at the lower rate and MPV at the higher rate. Now let's calculate our cost. Our cost will be equal to, the lower rate is 5%. 5, we add MPV at the lower rate divided by, we will open the bracket, MPV at the lower rate minus MPV at the higher rate. Then we have to multiply this by, we open bracket, higher rate is 6 minus lower rate is 5, like that. Then we get that percent. Let's round off to 2 decimal places. So the cost of the loan note is 5.4%. 5.4% like that. So we said this also will be our cost of bank loan, which is also equal to 5.4%. Why are we estimating the bank loan at 5.4%? Every time you'll be told a hint here that, let's go there to the question, that the bank loan has a variable interest rate. If you are told that the bank loan has a variable interest rate, it means use the cost of the loan note also in the cost of a bank loan. Now we have found all the costs of each finance element here. Now let's calculate our WACC. To calculate our WACC, we should also have another table that will make it easier. This table will denote it details here, then equity, then we'll say preference shares, we'll say loan notes, and we'll say bank loan. Then we'll have the book values, BV for book values. The book value of equity, we are told that ordinary shares equity here, ordinary shares is 12. I will work in million, 12 million. The preference shares irredeemable, they are 5 million. The loan note book value here is 10 million, and the bank loan is 3 million, like that. Then I will have the nominal values. The nominal value for ordinary shares we are given here 0.50. The nominal value of a preference share is 0.50. The nominal value of a bank loan we are given here, it's 100 here. The bank loan doesn't have a nominal value. Then we will get here, we will do also here our market values. The market value of our equity shares ex-div 7.07. The market value of our preference shares 0.31. The market value of our bank loan 102.34. There is no market value there. Then we get our total market value. Our total market value. Our total market value here, we will say book value divided by nominal value multiplied by market value. We can copy this here and here. The bank loan, the total market value is 3. Now from here, we'll have to sum up. So we'll sum up here to get that. Then we'll put our costs here. Our costs here, for preference shares, we say it is 11.7. 11.70. Our cost of equity, we said 8.06. Our loan note, we said 5.40. We said we'll use the same rate for the bank loan. Now here we'll have the product. Here the product will say total market value multiplied by the cost. Then we can copy the formula down. We can also sum here. We can put everything here to 2 decimal places. We can put everything here also to 2 decimal places. Then now we can calculate our WACC. Our WACC will be calculated as product divided by total market value. So our WACC will be that figure. Let's round off to 2 decimal places. So our WACC will be 11.9%. This is how we can calculate our WACC in an easier manner using Excel, as we are all doing the computer-based examination. The examiners, they mark the formulas that are here. They will be clicking on the cells and marking the formulas that you have put here. There is no need to try and put the formula for the growth rate, formula for the cost of equity, formula for the cost of preference shares, also the formula for the IRR. The examiners will be clicking the cells and marking the formula. Even here, our work, the examiner will click this cell and mark you correctly. Thank you very much. And if you have found this video useful, please subscribe to my channel if you have done so. Thank you so much for watching.